Equity investments are similar to debt investments, with the exception of the notable difference, which is that debt investments are investments from investors or creditors that do not take any ownership of the business, whereas equity investments do. So they do have some share in the business, and whether it's insignificant or significant share of ownership of the business, that's to be determined, of course, by the investor and the company or the organization that they're investing in. So, as you can see here for equity investments, there's a few categories here that you can see. You have insignificant influence that represents investors that have less than or that invest or own less than 20% of the shares, so they have insignificant influence on like companies' decisions and things like that. Investors that have significant influence um, own between 20 to 50% of the company, and controlling influence. So any investors that have controlling influence own more than 50% of the business. So you may have heard an investor or some investors that own 51% of the company. So they probably, gave away most of their shares, but they still want to have that controlling influence or control the business, which means that they're going to own at least 51% to still have control over the organization's decision and the direction that the organization is going to go towards. And so when it comes to accounting for equity investments, there are some differences in accounting for equity investments amongst someone that doesn't have that much influence compared to someone that does have significant influence, and also compared to somebody that has controlling influence. So the accounting is going to be different. And what I'm going to start off with is doing the accounting for someone that has insignificant influence. Now, again, when it comes to the accounts that are debited and credited, it is similar to debt investments as far as with debiting an account that's going to affect the balance sheet, and then crediting the account that's going to be affect the income statement. But again, it does depend on the level of influence that one has in the business. Okay, so when it comes to insignificant influence, let's go ahead and just provide an example here so that way you can see. So we're going to say that someone that has 19% influence over a business has stock investments or has stocks or have acquired stocks or shares, same thing. We're going to say in the amount of $20,000. Okay, so they acquired shares of $20,000, which equates to 19% of ownership in the business, which is reflected as an insignificant influence over the business. All right. So, what does this look like? This initial acquisition of stocks for somebody that has insignificant influence. So, putting together the journal entry here, we're going to put date, account, DR for debit, CR for credit. All right. So, we're going to say that the acquisition of these shares happened on March 1st. All right. So, since the purchase of the stocks happened in March 1st, we're going to say the purchase was made with cash. We're going to go ahead and credit cash for $20,000. Okay, the cash was spent for stock acquisition. So the account that's going to be debited is going to be stock investments for 20,000. Now let's say on March 31st, you have $20,000 worth of stocks, and the company made $500,000 in income, and you, out of $500,000, you're going to receive $10,000 from that income. So when that happens at the end of March, you're going to go ahead and debit cash for $10,000. And the account that you're going to credit is going to be called dividend revenue for that same amount. As you know, cash is a asset, so that's going to affect the balance sheet. Dividend revenue is a revenue account. It's going to affect the income statement. Okay. Now, let's say that you do have these stocks here. That's $20,000. Okay, that's sitting in that asset account, and we're going to say on March 31st, those investments, the fair value of those investments, because this is the cost of it. You purchased this at cost, March 1st. Okay, let's say on March 31st, those investments, the fair value of those stocks went up from $20,000 to, let's just say, $25,000. So on March 31st, similar to trading securities and available for sale securities that are actively traded on the market, you're going to go ahead and make the adjustments in your books, reflecting that $5,000 increase in value of those stocks. So the account that needs to be debited, reflecting the increase in value in the stocks, is going to be fair value adjustment dash stock for $5,000. And the credit is going to go to unrealized gain dash income for that same amount. So similar to debt securities, specifically trading securities, and also available for sale securities, we see that the debit is going towards fair value adjustment dash stock, which is a contra asset account that's directly connected to the stock investment account here. So that's going to increase the balance in that account. So that's going to affect the balance sheet. And then the account that's going to be credited, unrealized gain dash income, that's going to affect the income statement, specifically in the other revenues and gains section of that statement.